If you trade every liquidity sweep, you're setting yourself up for failure. Does this look familiar? So you see this liquidity and you see this liquidity sweep, you're thinking let's short the markets because the price has to go down right after the liquidity sweep. So you enter shorts and bang, price continues, you're left there sad, you're wondering what the hell happened. But in reality, you got faked out. Getting faked out is the worst, but don't worry, because in this video, I will show you exactly how I know when will the liquidity actually reverse the market, so you can finally stop losing money in the market and start gaining actual consistent profits. But first, quickly, what is a liquidity sweep? So essentially a liquidity sweep is when a high or even a low gets pushed above or pushed below. These areas are where a lot of orders are resting at, and by sweeping these liquidity areas, big banks can be happy because they have filled their large position, so we would expect a reversal from here, but that's not always the case. Sometimes there could be more liquidity resting above here, so the big banks want to sweep them first and then reverse the price like this. Now here's the problem. Most traders would have shorted the markets right here because they see this liquidity sweep, so they short the markets and bang, they got stopped out, right? That's a huge mistake because you need a process. So how do we know if the sweep will actually work and reverse the price? Well, you have to wait and see how price reacts to the liquidity. So as you can see, this is our liquidity right here, sell side liquidity, our lows. And right here is our sweep of liquidity. As you can see, it swept the liquidity, and most of the times, if the liquidity is strong enough, you'll see the price react to it immediately, creating this rejection candle, and that's a great sign that this had a lot of liquidity. Now on the other hand, if the price would have just continued this downtrend cycle like this and completely ignored this liquidity, that would have meant that this liquidity right here didn't have enough orders, so most likely it would continue down and take this liquidity and then perhaps reverse the price if this had enough liquidity. So you see, these big banks want to take out orders, fill their large positions, then they can actually reverse the price. But in this case, actually, this had enough liquidity and the price reversed completely. Now the question what you may be asking is, how can we actually make money off of this? How can we enter a reversal trade after a liquidity sweep? Well, let me show you. Now, once the liquidity gets swept, don't rush in and buy the markets immediately. You have to wait for two confirmation. Number one, a rejection candle that we saw right here. And number two, you have to wait for a market structure shift. Now, obviously, you may wonder what the hell is a market structure shift. Well, let me show you, because it's actually very easy to spot. And that way you can actually catch these reversal moves. First of all, like I said, rejection candle, we saw that, I taught you that. And then after that, I would go to the 1 minute time frame and I would mark out the most recent high in the trend. So this is the downtrend, and I would want to see a high, an up candle body close above the most recent high. And this right here is our first high closure above the most recent high, aka something called a break of structure. Now obviously, that's not enough. That's not the market structure shift yet for me. I would want to see a higher high, higher low, and higher high formation, meaning that now there's two break of structures because there's two highs closing above the most recent highs. This is a downtrend. Low lows, low highs, low lows, low highs, low lows, low highs, low lows. Liquidity sweep, and then higher highs, higher lows, higher highs. There's two break of structures creating that trend cycle. And now this is our MSS, market structure shift. And I would buy the markets right here, put the stop loss below this low right here, and I would target more liquidity so we can catch that trend reversal. And then we're going to be prepared when will the price reverse after that. These are the 50-minute lows that actually contain liquidity. When it gets swept, there's the candle rejection. Remember, the rejection candle, price pushes up immediately, leaving this rejection candle. I'll go to the 1 minute time frame, and what happens? When the price got swept, what do we mark out? This first, the most recent high actually. If you go a little bit further, what is this? This is a break of structure number one, because this is a fat part of the candle closing above the most recent high. I would mark out this high right here. Let's see if it gets breaking above. It doesn't yet. We actually create a new high. Remember, the most recent high counts in this case. So there's a new high, doesn't break yet. We actually create a new high right here. And then we finally break above the second time. So this is our break of structure number one. This is our break of structure number two. So what would I do? I would enter right here and I would put the stop loss below this low. And for this example, I would target like 1 to 2 risk reward ratio just for this example. And I would enter right there. and bang, there we go. So this is a higher highs, higher lows, higher highs. Now I enter right here. What happens? Trend continues. Higher highs, higher lows, higher highs, and then cycle continues. Now obviously it also applies to the opposite direction. So if there's an uptrend, there's the liquidity sweep, then we see those two breaker structures like this. That's a MSS right there, because there's breaker structure number 1, breaker structure number 2. What is that? MSS. A low closing below the most recent low 2 times, MSS, and that's when we can short the markets, because we see this downtrend movement and there's the liquidity sweep prior to that. Now let me show you what you don't want to see. If there's the liquidity sweep, it happens right here, you would expect the MSS, but if it just continues this trend cycle to the original direction, then most likely it will not reverse the price, because there might be more liquidity. You should mark them out so you can be ready for a potential MSS right there. But now it's not most likely going to reverse the price, because it has already closed in multiple times above that, and this liquidity just didn't have enough orders for the big banks to care. That's why I highly recommend you to spot the liquidity in higher time frames. I would recommend 15-minute time frames and up for the liquidities. Highs and lows above there, they're amazing. And now you know exactly which liquidity will work. But let's be real, this is not enough. This is a pretty nice guidance, right? But you need to know exactly how to play with time frames. You need to know top-down analysis, how to follow the trend, all that good stuff. So click the first link in the description if you want to get access to my free course. Imagine that, free course. So take it before I make it paid. And yeah, man, thank you for watching. Like, subscribe, comment if you like this video. As usual, I will see you on the other side. Peace out.